Hello everybody, this is Eddie Ghabour, CEO and co-founder of Key Advisors Wealth Management. Please subscribe to our YouTube channel or follow us on Twitter. My Twitter handle is @CommonSenseBull for latest videos and up-to-date commentary on things that we're doing for our clients. I just finished a Fox business interview with Varney and Company, and one of the topics that I touched on is this melt-up that we've been talking about. It's no secret that we were bearish at the end of 2021 and going into 2022, and we got late getting back into the bull run in 2023 and are pretty bullish, extremely bullish I should say right now, probably as bullish as we were in 2021. And we think that the reason why we have really grossed up our exposure to higher risk assets is we are witnessing a melt up really because of, I'll call it an artificially inflated melt up because of the amount of debt that continues to get printed. And now we have a Fed on top of the debt that's saying that they're going to more than likely cut rates sometime this summer. I completely disagree with that policy, respectfully, because the last thing this economy needs is inflation to reaccelerate. And when you pump a lot of debt into the system, and now you're going to have an accommodative Fed, that ultimately, that's common sense, right? That's going to cause asset prices, in our opinion, to go up. So we believe we are going to see a melt up that probably far exceeds anyone's expectations in regards to how high asset prices go in the coming months. We have absolutely grossed up our exposure, but it's not just grossing it up, it's where are you grossing it? In our opinion, the higher risk assets, those outliers are going to be the ones, and again, you have to have the right risk tolerance for it. They're going to be the ones that outperform the S&P if we're right, because there are areas that haven't participated in this market the way that some of the other areas have. But this is a high beta play on our part, again, within everyone's risk tolerance and goals. But if your goal is to beat the broad index, that's going to be how you play it. Because look, is there more of a Goldilocks scenario where the government's just going to print endless amounts of money and the Fed's going to cut rates because everything is fine? That's going to cause an extreme moves in markets. Doesn't mean we're not going to get corrections. We fully expect them. We'll be buying. We generally have dry powder regardless of how bullish we are, so that way we can take opportunities of disconnects that happen in the marketplace. But the most important advice I can give you with all of this being said is now is the time to ask yourself, do you have an exit strategy? What is your plan? Because there are some that just, there's never a market they don't like to buy regardless of how inflated it gets. And for those of you that have followed us for years, you know we're not like that. We're going to be open-minded, and we will be buying when we think the time is to buy, and we'll also sell when we think the time is to sell. And we've been very clear with that. But what we have shared with our clients is not only the game plan right now to take advantage of this reckless spending and loose monetary policy, but what we're going to do on the back end. We believe that if they are going to be cutting rates, that they are setting us up for a hard landing next year, potentially. And the reason why we say that is because there is a probability now that I don't think anyone's pricing in that we will get inflation reaccelerate either towards the end of this year or next year due to this loose monetary policy, due to markets rising, due to real estate rising. And what that will ultimately do is cause the Fed to potentially have a Volcker moment where they have to come in and raise interest rates. No one's really talking about that because we think the worst is over. All they've done is put a Band-Aid on a bullet wound in the sense that this inflation is not done yet. And all they're going to do with this policy is cause it to reaccelerate, in our opinion. And if that happens, and we now have a cycle where Fed has to raise rates, then you're more than likely going to see a pretty sizable correction. We will have the mechanisms in place if we continue the way that we do to de-risk. But my biggest concern is there's a lot of investors out there that wait until something happens to put together a game plan. And what we're telling you is now is the time. Now is the time to enjoy market returns, but also have a strategy, a plan B, in case things don't work out as we go into next year. I hope I'm wrong. I hope that they're able to keep inflation or have inflation go down and we have a multi-year rally. I just don't see how that's possible. I think everyone would agree, regardless of your viewpoints, that when you cut rates and throw money into the system, that's inflationary. You're seeing it in oil and energy prices right now. You're seeing it in certain commodities. And if they do cut rates, it's just going to cause other assets to inflate. So it's going to be wonderful for us that own assets. It's going to be tough for those that don't because the cost of living is not going to get any better. It's probably going to get harder. And then as an investor, again, have a game plan so that way what happened to you in 2022 doesn't happen to you again in 2025 if we are right in our thoughts of inflation reaccelerating. So that's our 2 cents for today. I hope this brings value to you and your family. And as always, just because our opinion is one way doesn't mean you have to agree with it, and certainly doesn't mean you have to act on it. You have to decide for you and your family what's best for your net worth. So I hope you have a wonderful month of April and hope you make this a winning week. Thank you.